All right, again, let's go ahead and get started. Today is Wednesday, October 5th, 9:30 a.m. section. This class is being recorded. What we're going to spend our time today is on Lecture Note 4. I posted an updated Lecture Note 4 last night. This will be the precursor to doing Homework 6, which will be the analysis of the converted statements. All right? So we just finished the conversion of the statements. So now we want to talk about analyzing two statements, right? One will be what's called the ROIC tree, or the key value drivers of the ROIC. And then the second one will be analyzing the CFI, cash flow available to investors. Right? Now, I like to say that you can't drive a car looking in the rearview mirror, right? So we are looking backwards, and we do valuation. We will be focused more on the future, but nonetheless, we need a baseline, and we do kind of have some understanding of what is going on with the company and the industry. So we're going to look at two statements. The first one is going to be the ROIC drivers. Now, in the next section of the class, we're going to get into valuation, and you're going to build a valuation model. So if you don't know Excel, trust me, you will by the end of this semester, but you'll be building an Excel-based valuation model tied to Bloomberg. Take us a couple weeks to build the first model. Take us 10 minutes once we build the first model to do another company. Okay? So one of the outputs of the valuation model is it will create an ROIC tree, which we are going to analyze. Right? Now, when we analyze the drivers of return on invested capital, we're going to look at two levels of analysis. You have to cover all of that in your write-ups and in your presentations, right? So the first level of the ROIC drivers basically explain ROIC, and more importantly, explain the changes in ROIC over time. There are three. The first one is the tax rate. The second one is the operating margin, or the EBIT margin, the pre-tax margin of the firm. And the third is what we're going to call productivity or efficiency. Okay? Those three things explain ROIC. Right? So we're going to talk about each one of them and how the changes in any of those affect the changes in ROIC. So that's the first part of the analysis we're going to do. The second part of the analysis, called second level, is that operating margin comes from the income statement. So what on the income statement explains the operating margin and the change in the operating margin? It will be three things. It will be the change in the gross margin, the change in the selling general administrative or overhead expense, and the spending on depreciation. Those three things explain operating margin, so we're going to explain the operating margin by changes in those three things. As also part of our second level analysis, we're going to look at the balance sheet, which drives the productivity. So productivity, also known as efficiency, is going to be a function of working capital, PP&E, and intangibles as a percentage of sales. Right? So we'll look at each of those and the impact on the changes in the balance sheet and the impact on ROIC. Okay? So again, when we go through the ROIC tree, we will cover all of this. Right? And this will be part of your write-up. This will be part of your presentations. The second statement that we are going to analyze is cash flow available to investors, aka CFI. As you know from your conversion, it has four sections tied to Modigliani-Miller. It has the operating cash flow, which is called free cash flow. So we'll start there, and we'll talk about two of the primary drivers. One is gross cash flow, or cash flow coming from the income statement, and gross investment coming back into the company, into the balance sheet. And that's going to help us understand what's going on with the operating free cash flow of the firm. We'll then look at the non-operating cash flow impacts of CFI, primarily excess cash, change in excess cash, and or change in the non-operating assets, right? But nonetheless, those two together, free cash flow and non-operating cash flow, explain CFI. So we'll explain that. Then, if we have CFI, we're going to pay it out, distribute it. So then we'll look at where the money went, debt holders. That's going to either be interest expense or change in debt, For shareholders, dividends, change in equity, common or preferred. Okay? Now, it could also include some stock buybacks. Right? Now, if the company has negative CFI, then we're going to look at where the money came from. Again, from debt and or equity. But nonetheless, our analysis will cover all 4 sections and explain the changes as we go across those sections. Right? That's what we're going to start doing. And again, homework 6, you'll be doing that for a company called Dentsu. Okay? And you'll be going through their ROIC tree and their CFI. Now for homework 6, I like to say the training wheels will be on. So I'm just going to ask you to explain the numbers, the change in the numbers as you're kind of putting all the pieces together, connecting some dots. Okay? But you got to use numbers when you do the analysis. However, after homework 6, for other assignments, including your group project, you are going to have to explain everything, numbers, plus the real world examples. Right? So if you see a big change in goodwill, that's a big flag that the company probably bought somebody. So as part of your analysis, you'll tell me who they bought. Okay? And for the homework 6, we're going to kind of focus, for example, CFI on the totals in the ROIC tree in the beginning and the end of the 5-year period. After homework 6 and for your group projects, you're going to be responsible for the intermediate years as well. Okay? So again, I'm just doing it simple, but it will get more complex. Right? Now, let's start out with the ROIC tree, and we're going to use Starbucks as our working example. So this is a 5-year ROIC tree of Starbucks. This ROIC tree will be created automatically by the valuation model that we're building. So I actually pulled this right out of our valuation model. Right? This is what you're going to be working on in a few weeks. So this ROIC tree, you can see it here, it says EOY ROIC. This one's based on end of year ROIC. Okay? So in your previous assignment, I asked for BOY, beginning of year ROIC, current year no plat divided by previous year's invested capital. This tree is based on current year no plat divided by current year invested capital. Okay? So that's what EOY stands for. Now, the way to read this tree, and again, we're going to do the first level analysis first, where there's 3 drivers that explain ROIC, is we're going to start by explaining the 5-year change. So making this a little bit bigger, it's easier to see. All right, right here, we can see that Starbucks ROIC in 2017 was 48.3%. In 2021, it fell to 23.2%. That is a 5-year drop of 51.9%. Okay, so that's the first thing. Why did Starbucks ROIC fall from 48.3 to 23.2% over the 5 years? Driver number 1, the tax rate. In 2017, Starbucks paid 33.2% tax rate. In 2021, Starbucks paid 21.6% in tax rate. That was a 5-year drop of 34.9% in its tax rate. So the first point is, did that help or hurt Starbucks ROIC? Did that drop in tax rate help or hurt their ROIC? That's a question to the group. Help or hurt? Did the drop in tax rate cause the ROIC to go up or down? Yes. Should help. It should help the ROIC to go up. So we know that the ROIC didn't go down because of the tax rate. As a matter of fact, the ROIC should have gone up because of the less tax rate. But this is what I mean by connecting the dots between the drivers. So even though it didn't hurt the ROIC, we still want to say the tax rate should have helped the ROIC when it fell from 33.2% to 21.6%. So we clearly know that the ROIC drop over 5 years was not because of tax rate. It was because of the pre-tax ROIC. The operations of the business got worse. Right? Over that 5-year period, the pre-tax ROIC in 2017 was 72.3%. In 2021, it was 29.6%. That's a 59% decline in the pre-tax ROIC. Okay? So why did Starbucks operating ROIC from the operations get worse? Pre-tax, drivers 2 and 3. The first one is the operating margin. That's EBIT, or operating profit, divided by sales. The second one is what we're going to call productivity or efficiency, right? Or sorry, third one. Second one is operating margin. Third one is invested capital to sales. That is basically how much we're spending to generate $1 of sales, right? So just to give you, again, some insight into this, and I will try and draw this, probably poorly, on my screen. Operating margin is basically profit divided by sales, or P over S for short, right? ROIC, return on invested capital, is basically profit divided by invested capital, which I'll just call I, right? That's return on invested capital, just expressed as an equation. If we multiply P over S by blank over blank, that will equal P over I. What is blank over blank? P over S times what is P over I? What must it be? Does anyone remember algebra? P over S times what over what equals P over I? What is the blank over blank?
S over I.
Thank you. S over I. Okay. Glad somebody remembered their algebra. I barely do. Because the S's will cancel out. Okay? Now, what's important about writing this little equation here is this multiplication sign says both of these have equal weight. P over S and S over I have the same weight. So, when we think about the drivers of ROI, return on investment, ROIC, return on invested capital, there are two. P over S is your profit margin, how much you make when you sell something. That's the operating margin. Times how much you have to invest to sell it. That's the productivity or efficiency. Those two things are equally important in explaining ROI. The difference is in the equation, it's S over I. In the tree, it's I over S. I did the reciprocal. Okay? You might say, well, why did he do that? Two reasons. I'm using the reciprocal in the tree because, number one, companies tend to think in terms of sales. Meaning, I sell something, how much did I make? In order to sell something, how much do I have to spend? Okay? They don't think in terms of investment. Second, we're going to add up the tree. Okay? And we add up the percentage of sales on the balance sheet, keeping sales as the denominator will be important. Okay? So the point is, if you take operating margin times, and that's the formula over here, 1 over invested capital to sales, then you get your pre-tax ROIC. So I'm just using the reciprocal there. But the point is, these two things, driver number one is tax rate. Driver number two is operating margin. Driver number three is invested capital to sales. Those are the three drivers of ROIC. So we just explained the first one, tax rate, which went down, again, from 33.2 to 21.6. That should have helped our after-tax ROIC, right? So the reason the after-tax ROIC went from 48.3 to 23.2, again, is because the pre-tax ROIC went from 72.3 to 29.6. That 59% drop is the whole reason why the after-tax ROIC went down. So back to the drivers we just identified, the operating margin. Operating margin of Starbucks went from 18.5 cents, which means they made 18.5 cents when they sold a cup of coffee after they paid their operating expenses, to 16.8 cents per dollar in 2021. that 9.2% drop in operating margin over the 5 years hurt their pre-tax ROIC. They're making less at every sale. Okay? Driver number 3, invested capital to sales. In 2017, to sell that cup of coffee, they spent 25.5 cents on their balance sheet, on their invested capital. In 2021, to sell the same cup of coffee, they spent 56.6 cents in invested capital. That's a 121.6% increase. Does that improve your ROIC or does that hurt your ROIC? If your invested capital over sales goes from 25 to 57, does that help or hurt the ROIC? It's going to hurt it because you're spending a lot more investment to drive sales. Okay, so that's less productivity. So generally, a higher invested capital to sales hurts your ROIC. A lower invested capital to sales helps your ROIC. A higher operating margin helps your ROIC. A lower operating margin hurts your ROIC. In the case of Starbucks, their operating margin went down by 9%, and their invested capital to sales more than doubled from 25.5 to 56.6. Both of those hurt their pre-tax ROIC. Which one hurt it more? The drop in the margin or the worsening of the productivity? Which of those two had the bigger impact to the drop in the pre-tax ROIC? Was it the margin or the productivity worsening? It was the productivity worsening. That's what you need to say. Okay? So not only are you identifying each of the 3 drivers, how they're changing and how they affect the ROIC, but you're also kind of giving a sense of magnitude, saying, look, of the 2 that are hurting the ROIC, the productivity hurt it more because that was a bigger impact than the drop in the operating margin. Clear? Because what you're saying, that's what you're writing up as part of your analysis. And notice, I am using numbers. I don't care how many words you write. You don't use numbers, you don't get credit. Okay? You have to use numbers. If for no other reason, then when I'm using numbers, you know what I'm talking about. If I don't use numbers, you won't know what I'm talking about because I'm making general numbers, just general comments. Okay? That is the first level analysis for Starbucks. Now let's talk about the second level analysis. Why did the operating margin fall from 18.5 cents to 16.8 cents? Well, that's the income statement. Those are those 3 numbers on the right. So, what is operating margin? Operating margin is gross margin minus SG&A as a percentage of sales minus depreciation as a percentage of sales. Those 3 things equal operating margin. Okay? So, let's look at the first one. Gross margin in 2017 was 35.3. Gross margin in 2021 was 34.1. They actually saw a 3.3% decline in gross margin. That is going to hurt the operating margin. So one of the reasons why the operating margin of Starbucks fell is they lost essentially 1.2 cents by a lower gross margin per dollar of sales between 2017 and 2021. Selling general administrative, this is the cost of running your business kind of day to day and sales, marketing, etc. That went from 13.8 cents spending per dollar in 2017 to 13.4 cents in 2021. Well, that 0.004 drop in SG&A, pretty flat, but slight drop, that actually would have helped them slightly with their operating margin. Okay? So far, the big driver of the drop in operating margin is the drop in the gross margin. Price minus cost as a percentage of sales. All right? So either they're charging less for their coffee relative to the cost of the product, right? So it means that either their price went down and the cost didn't change, and I've been to a Starbucks recently, I don't think that's the case, or the cost of coffee went up relative to their price, right? I think that's probably the more likely thing. But the point is, they're getting slightly less markup on their merchandise, okay? Now, the third driver on the income statement is depreciation as a percentage of sales. In 2017, they were spending 4.8 cents per dollar on depreciation. In 2021, they're spending 5.2 cents per dollar. That's slightly worse. Okay, so that extra 0.004 of depreciation further reduced their operating margin. But if I really wanted to say the primary driver that caused the operating margin to go down, it was the drop in the gross margin. That was the biggest reason off the income statement that their operating margin fell. Looking at the second level for productivity, looking at the balance sheet. Invested capital to sales is a function of three things. It's working capital, operating working capital, plus property, plant, and equipment, plus goodwill and intangibles. Right? We know that from our rearranged statements, so that's what we're adding up here. Operating working capital, OpWC to sales, is operating working capital as a percentage of sales, plus property, plant, and equipment, the building, land, and everything, equipment inside them, as a percentage of sales, plus spending on intangibles to sales, mostly goodwill. Add those three together, you get invested capital sales. So those three things on the right explain what we're going to call productivity or efficiency. So we know that their productivity worsened. Spent a whole lot more to generate sales. Why? Well, the first one is operating working capital. In 2017, operating working capital was negative 5.3 cents. Right? What does that mean? What does it mean to have negative working capital? How does one have negative working capital? What must be true? Yep. Yeah, your current liabilities had to be higher than your current assets. So basically, is that going to help or hurt your ROIC? If you have negative working capital, does that help or hurt your ROIC? And by the way, in case you're curious what the difference is between the midterm exam and a final exam, these are final exam questions. Okay? So for the plug and chuggers out there, you're going to have to answer real questions about the theory about what you're actually calculating on the final exam. Okay? Midterm, you're just converting statements. Final exam, you're going to tell me what it means. So back to working capital. If working capital is negative, does that help or hurt your ROIC? Well, if you have less working capital, do you have more or less invested capital? You have less. And if you have less invested capital and the same profit, then you have higher ROIC. So a negative working capital reduces invested capital. Okay? So they had negative working capital in 2017. They had more liabilities than assets. Basically, their vendors are helping provide free financing. Okay? Now, in 2021, working capital went to negative 7.5 cents. They went 2.5 cents more negative. Did that improve the ROIC? Did it improve the invested capital sales? Or did that make it worse? Actually made it better. Because now at negative 7.5 cents, negative, I have even more current liabilities. So it actually reduces my invested capital even more. So the drop in working capital, having even less working capital, or negative, actually should have helped their productivity. That's not why their productivity worsened. Driver number 2 off the balance sheet, PP&E to sales. In 2017, they spent 22 cents per dollar, again, on their stores, primarily. In 2021, they spent 50 cents per dollar on their stores. That clearly was worse. They're spending almost 28 cents per dollar more on their stores per dollar of sales than they did in 2017. That's the real reason their productivity worsened. In 2017, they had spent 8.8 cents cumulatively on goodwill and intangibles. In 2021, they spent 13.9 cents on goodwill and intangibles. Clearly, they bought somebody, and they increased the amount of spending and acquisitions. That also reduced their productivity further. As a matter of fact, when did they do the big acquisition? What year? What year does it look like they made a big acquisition? Yeah.
2018.
Yeah, because in 2018, goodwill went up from 8.8 to 18.5. So the natural question would be, who did they buy? You should know that. Okay? If you don't know that, particularly on your group project, if this were your group project, I will be marking off points. Lots of points. Okay? So this is what I'm saying. Like homework 6, I don't expect you to know everything about these companies. In a few weeks, for your group project, I expect you to know things about these companies. All right, same thing for future assignments. You got to put the real world context. That's the other thing. For homework 6, I'm only asking you to do the beginning and the end, year 1, year 5. After homework 6, you got to care about the other 3 years. Okay, so again, this is kind of the easier part of working our way into these statements. Okay, so what I know about invested capital to sales is it worsened primarily because PP&E to sales went up 128.7% to 22 cents to 50.3%, 50.3 cents. That 28 cent per dollar increase, along with an increase of about 5 cents per dollar in intangibles from 8.8 to 13.9, that's why Starbucks productivity worsened. Now that I've explained the drivers left to right, I summarize right to left. So, summarizing. A worsening of productivity primarily by an increase in PP&E to sales from 22 to 50.3 drove invested capital to sales from 25.5 to 57, which was the primary reason the pre-tax ROIC fell from 72.3 to 29.6. Now the operating margin also worsened, but not as much as the impact of that PP&E and the productivity drop. And the operating margin did worsen because of a slight decline in gross margin from 35.3 to 34.1. That was the driver of the operating margin going down 18.5 to 16.8. But again, that did not have the bigger impact. The real big impact in the drop in ROIC pre-tax was the spending, particularly on the PP&E. It was slightly benefited by a lower tax rate as they paid basically 21.6 cents in taxes versus 33.2 cents in taxes, primarily due to the Trump tax cut, right? And basically saw their overall after-tax ROIC fall from 48 to 23. That's what you need to say. That's what you need to write up. Those are the numbers you need to be talking about, and you got to connect dots along the way. Questions about any of that? Yes.
So
Start here first.
Just a question about the homework. When we do the homework, since we obviously don't have the valuation model yet, do you want us to still do it in this tree format?
I'm giving you a tree in the homework. If you go look at the homework 6, you're going to see a PDF file with a tree and a CFI. And it's for a company called Nokia. So you're going to basically walk through Nokia's tree for the homework. Same thing. And again, I didn't even need to give you a company, to be honest with you. I'm just giving you the company so you have a little bit of context for this homework. Now, for another homework, when you see big changes for Nokia, I would fully expect you to tell me what's going on with Nokia, that those numbers at least are giving some insight to. But for this homework, you do have the tree. You don't create it yourself. Yes, sir?
So for the homework, we go, again, left to right, and then back down right to left.
Correct. Yeah, so left to right, cover the first level 3 drivers that explain the ROIC using numbers and linking it back, higher, lower. And then go to the second level, margin driven by these 3 things, what changed the margin, invested capital driven by these 3 things, what changed the invested capital, and then summarize the key points. So I'm trying to get you to connect dots, right? And you might say, gee, do I really have to talk about every item on this tree for homework 6? Yes, I want you to, because it's going to help you start to understand the relationship between these things, right? Because again, this is almost like learning a new language, and then the only way you're going to kind of learn it is to basically go through everything. And then the other thing is I want to make sure that you're connecting dots. I want you to understand that a reduction in working capital actually improves ROIC. So saying that will help you start make sure you're linking that to the way that the tree works. Because you could just walk through this tree and just regurgitate a bunch of numbers. This number higher, that number lower. This number higher, that number higher, that number lower. That could be your write-up. You're going to get a really poor grade because that doesn't say anything except you can read. And I can imagine if you're here at the University of Maryland that you can read. You can read numbers. That's not the point of this assignment. Can you tell me what the numbers connect to? Can you tell me whether it's better or worse for what we're trying to analyze here? That's the more important part for this assignment. Questions about ROIC? Let's do another company. This is Target, or some people call this Target. Okay, so again, 5 years, 2017 to 2021. start out with 2017. In 2017, Target's ROIC after tax was 13.5%. 2021, it increased 52% to 20.5%. So they had a big jump in their after-tax ROIC. Driver number one, cash tax rate. In 2017, their cash tax rate was 32.7%. 2021, it fell to 21.2%. That 35% drop in the cash tax rate should have helped the ROIC. So one of the reasons why Target's ROIC improved was because of the tax rate. Now, Starbucks improved their tax rate too. It's just they still had a drop in their ROIC because their pre-tax ROIC got worse. Starbucks' pre-tax ROIC got better. So the Target's underlying business got better over the 5 years as it went from 20% to 26% in pre-tax ROIC. Okay? So why? Why did it get better? By the way, he talked to me about leaving early for excused absence. Why did the why did the pre-tax ROIC get better? First, operating margin. Operating margin went from 7.2 cents in 2017 to 7 cents in 2021. That actually should have hurt the pre-tax ROIC. So that's not why it went better. All right? Matter of fact, you can call it flat, but basically went down by 2.3%. So it wasn't the margin at Target that caused the pre-tax ROIC to go up. It was the productivity. Now, their productivity was the opposite of Starbucks. At Target in 2017, they were spending 35.7 cents per dollar on capital, per dollar of sales. By 2021, Target was only spending 26.8 cents on investment to generate $1 of sales. They got a lot more efficient. That's why the underlying business got better. Okay, that's why the pre-tax ROIC went up. All right? But even though there wasn't a big change in the operating margin, we still want to talk about those other three drivers. All right, so why did the operating margin go from 7.2 to 7? Did anything change in the income statement? Well, gross margin went from 32.6 to 31.9. So basically, they're getting less markup on their products, right, relative to their cost. Right? Their gross margin actually went down by, in this case, 0.7%, 0.007. So basically, that should have hurt their operating margin. It didn't explain all the drop. It's actually more than the drop of the operating margin that they saw. Their SG&A spending went from 22.1 to 22.3. It's pretty flat, but again, an extra 0.002 spending in SG&A. That also would have hurt their operating margin. But their depreciation went from 3.3 to 2.7. Okay. So really, it was the slight drop in depreciation of 0.006, which offset the drops in the gross margin and the SG&A. All right? Or sorry, the drop in the gross margin and the slight rise in the SG&A is what I should say. That caused the operating margin to slightly go down from 7.2 to 7. Right? Would have been worse if they didn't get the savings for the depreciation. But ultimately, it was about flat for their operating margin. 0.072 and 0.07 is basically about the same. Okay? So now what happened on the balance sheet? Why did the invested capital to sales get worse from 35.7 to 26.8? Or sorry, get so much better from 35.7 to 26.8? First, working capital. They have negative working capital as well, although it wasn't negative Starbucks, but negative 0.002. Pretty much zero working capital. Okay? Now that went to negative 0.05 in 2021. So that improved. Right? Now, here's where we got to be careful. That's a 2,754% increase. Right? So even though it's a giant percentage, the magnitude may not be as much. You got to be careful about these percentage changes. They're there to more guide you on change, right? But sometimes a big change in a tiny number is not important as a small change in a big number. You just got to be careful about your magnitude when you're writing this up, okay? So again, next driver of invested capital is PP&E to sales. In 2017, they're spending 35.5 cents on stores per dollar of sales. By 2021, they're spending 31 cents on stores per dollar of sales. That got better too. So they had two things that were improving. They had more negative working capital, and they're spending less on PP&E to sales. Both of those reduce their invested capital to sales. right? The third driver was intangibles, 0.004 to 0.007. They didn't really do a lot of acquisitions, right? They didn't do them legacy before 2017. They got a tiny bit of goodwill and intangibles, and they didn't really change that much over the 5 years. So for Target, it was all organic. There wasn't really a lot of inorganic activity there. That's what we could see by looking at the balance sheet. Okay. So summarizing from right to left, Target improved its pre-tax ROIC primarily because of the improvement in working capital and PP&E to sales, 5-cent drop in working capital sales, 5-cent drop in PP&E to sales, which led to an overall drop in invested capital sales of 24.8 cents or percent from 36 cents to 27 cents, with flat operating margins, improved their pre-tax ROIC from 20 to 26, which combined with a lower tax rate, falling 35% from 32.7 to 21.2, led to an increase in the ROIC from 13.5 to 20.5. That's the right to left summary. Notice as I'm going through there, I am still using numbers. Notice I'm going from level to level. I'm connecting to whether it's improving or not improving ROIC. I'm just not just reading a number, right? Even if you know that as you're looking through this, I still need you to say that as part of your assignment to make sure that I know that you know that. All right, questions about what we just did? Okay, this is Dollar General. I'm going to pause here for a minute or two and give you a chance to look at and absorb the Dollar General data, and then I'm going to ask for somebody to help me start walking through this, or I will call on volunteers, and you will forcefully volunteer, so one of the two. So I'll give you guys a couple minutes to look at Dollar General. All right, does anybody want to help out with the first level analysis? Start with the first level. Okay, appreciate the volunteering. Go ahead.
Yeah. So we could start with end of year ROIC dropping. What is that, 16 to 11%?
16 to 11.6, yeah.
Okay, yeah. And that was largely due to cash tax rate rising, so that probably hurt the end of year ROIC.
The cash tax rate went from, can you read the numbers? Do you want to stand up and come a little closer? A little bit easier? Or look at that screen, one of the two. That's okay. So the cash tax rate, you said hurt the ROIC?
Yeah, end of year ROIC, it rose from 19.3% to 21.7%. And then you want me to go to?
Keep going. You're doing great.
Cool. And then we could hop up to pre-tax return on invested capital, which fell from 19.8 to 14.8%. So that fell. That looks like it was caused by decrease in productivity
Mm-hmm.
because they started spending a lot more to generate the same in sales. You could see in 2017, invested capital sales was 0.43 cents basically, and then it jumped almost over 20 cents to 63 cents. So that's almost 50% increase.
Mm-hmm.
Operating margin didn't really play a role in that. It actually increased over the same time period.
It didn't play a role in what?
Oh, so in the decrease in pre-tax ROIC,
Okay.
and then
Because the operating margin went from,
went from 0.086 to 0.094.
okay, so all of the drop in pre-tax ROIC was the productivity drop.
Correct. Yep.
Okay, great job. There you go. Well done. Right. Got almost 100% on that. The only part is just make sure you keep connecting those dots, right? Because again, I know he knows what he was talking about, right? But as I said, it's just good practice to make sure that the person you're talking to can follow what you were thinking that's actually going through your head. I like to call this tacit. It's just tacit knowledge to you. It's obvious to you, but that's the whole point. Like, you got to make it obvious to the grader that you know what's it you're actually saying, because otherwise I don't know what's swirling around in there. Right. All right. So who wants to do a second level? Second level income statement. Why did the operating margin go up? Yes.
Okay, so starting with the operating margin, which in 2017 was 8 cents, and then 2021 was 9 cents, so a 10% increase. Starting off with the gross margin, that increased about a cent from 32 in 2017 to 33 and a half in 2021, which was a 3% increase. The SG&A stayed flat from 22 in 2017 to 22 in 2021, so it didn't have really any effect on the operating margin. And then depreciation also relatively stayed flat, although it jumped from 17 or 1 cent, 0.017 in 2017 to 0.019 in 2021, which hurt the operating margin, but not enough for it to decrease. And then going off to the invested capital.
I'll just stop right there. I'll let somebody else that. Great job. Okay. And one other thing, this is a good example of why you got to be careful about those percentages, right? Because he didn't say this. He said he had it right, but the percentage change in depreciation is much bigger than percentage change in gross margin, but the depreciation's tiny. So the 8.8% had a very trivial impact. And he said it right, but I'm saying that's why you got to be careful about these percentages. They show you change, but magnitude is also important, and that's why he said the real magnitude there was not the depreciation, even though it worsened a little bit. It was really the improvement in gross margin that helped the operating margin. Yes, sir.
Wait, so during the homework on like our presentation, should we not address the percentages at all then? And just said, should we
I'm not saying you can't address percentages. I'm just saying be careful when you do use the percentages, because you might say, hey, depreciation went up 8.8%, but it was a pretty trivial amount by 0.002. Okay, but I just, so again, they're there to kind of help you guide higher or lower and how much. So this is a big change, so I want to know something has a big or small change, but a big change in a tiny number may not be as important as a small change in a big number. So you have to also think about both. Okay. All right, third section, productivity. Who wants to go through the second level productivity? You got two tough acts to follow. Okay, go ahead.
Alright, so we can see that productivity actually decreased. In 2017 it was 0.431, in 2021 it was 0.638.
Mhm.
So we can take a deeper dive. We can first look at operating working capital per sale. So it's 8 cents in 2017 and it decreases to 5.4 cents in 2021, which would actually help productivity. But that's just a small percentage of the PPE divided by sales, which increased 266% from 11.5 cents to 42.2. So that's going to hurt efficiency or productivity. And then finally, we have intangibles divided by sales, which went from 23.6 cents in 2017 to 16.2 in 2021. So that would also help productivity, but the large increase in PDE divided by sales is gonna be responsible for the decrease overall in productivity.
Yeah, couldn't have said it better. Very well done. All right, all three of them did a great job. Like I said, if you guys do that in your homework 6, you're golden. They did a well done. That's exactly what we want to do. And then just finally, if you want to quickly summarize right to left, the big jump in PPD to sales, as he just pointed out, from 11.5 to 42, was the primary reason invested capital sales got worse from 43 to 63.8, which offset the improvement in operating margin from 8.6 to 9.4 to lead to the pre-tax ROIC falling from 19.8 to 14.8. Okay, which then was slightly benefited by the lower tax rate from 29 to 21, or sorry, slightly worsening tax rate from 19.3 to 21.7, which led to the overall after-tax ROIC falling from 16 to 11.6. Okay. That's Dollar General. Questions about the ROIC tree, how we're analyzing it, what we're saying, how to do it? Okay. All right, statement number 2. Let's go back to the top here. Go back to Starbucks, and let's look at CFI. So CFI, this is going to give you 5 years of CFI. And then the final column on the right is the total. It's literally just the sum of the 5 years. Okay, kind of get like an average over time. So here's the idea. For homework 6, you can spend most of your time on the total. Right? After homework 6, just like the ROIC tree, you got to care about the other 5 years. Right? But nonetheless, there are 4 sections of CFI. You have to talk about all 4 sections. Right? Your first part of CFI is going to be operating free cash flow. And by the way, that's where you start. And the free cash flow is telling to how you're going to do the analysis. If operating free cash flow is positive, why is it positive? And where'd the money go? What'd they do with it? So the other 3 sections is more of like, where'd they put that operating free cash flow? And the non-operating, the debt, and the equity. Who got that money? If the operating free cash flow is negative, then where'd they fund it? Where'd they fund that loss? Do they get it from non-operating debt or equity activities? So the whole point is your free cash flow is going to kind of frame how you do the analysis. If positive, where'd the money go? If negative, where'd the money come from? Okay, but we start with free cash flow. Right? So in this case, Starbucks free cash flow over 5 years total summed up to be $3.2 billion. Okay? How did they generate $3.2 billion of free cash flow? Well, they generated $20.99 billion of gross cash flow from the income statement. Okay? They then reinvested, gross investment, $15.96 billion into their balance sheet. That averaged a 76% reinvestment rate. So Starbucks is putting 76% of their cash profit from the income statement back into the business. Right? Now, when we look at how they're reinvesting, Starbucks actually saw a decrease in their working capital of $958 million. So all of that reinvestment was in capital expenditures. It had more to do with stores and equipment than it did with inventory of coffee. Now, after that reinvestment of $15.9 billion, they ended up with $5 billion of free cash flow before acquisitions. They spent $1.79 billion on goodwill and intangibles, giving them $3.235 billion of free cash flow. By the way, what year did Starbucks make a good size acquisition? Yeah. Yeah. Who'd they buy? Yeah. So that'd be the point. Like, I would expect you at some point to know that. Because obviously, you see a big jump in goodwill. That's a big clue that they probably bought somebody to create that goodwill. So you should know, well, who did they buy? Okay. So that would be a question I would ask you later. or you'd have written it out in your next homework assignment. Okay. Again, homework 6, you're getting a pass on that as you're kind of putting the statements together. But post homework 6, that's the type of stuff I expect you to start to look at. You got a wonderful tool called Bloomberg to go back and check these things out. Okay. Now, the other thing I want you to look at is the ratio of Capex to depreciation. Okay. Depreciation, as you know, is the wearing out of assets over time that accountants do. It's usually straight line. But the idea is that I need to spend my depreciation, I need to put it back in Capex to basically tread water, right? Because if I don't spend my depreciation on reinvestment, then my business is going to start to deteriorate. I'm not going to be able to sell as much. And if I spend more than depreciation, I'm probably trying to grow, okay? Because basically the assumption we make, not always true, but generally the assumption we make is that you have to spend your depreciation in Capex to basically maintain what you have, right? If you're spending a lot more than that, you're probably trying to grow. And if you're spending a lot less than that, you're probably not trying to grow. Why would I want to add stuff if I'm not growing? Matter of fact, maybe I want to shrink a little. So, what does a 247% Capex to depreciation ratio tell you about Starbucks? They're spending 2.5 times depreciation over the 5 years. What were they trying to do? Yeah. They're trying to grow. They're clearly showing growth. Now here's the more important thing. 2021, what does that ratio tell you about 2022? What's the Capex to depreciation ratio in 2021? What number is that? 115%? Where's that number? What does 115% tell you? Are they trying to grow as much in 2022? Do they have big growth expansion plans in 2022? Probably not. Because they've been averaging 247%, now they're down to 115. They're barely spending a little bit more in depreciation. So what I'm telling you is sitting there in plain sight, management can often telegraph its growth intentions if you actually look at this ratio. Because think about this. If I want to grow, I'm going to have to build something first, and I'm not going to build something if I don't expect people to come. I'm not going to add a lot of stores if I don't think people are going to show up. So why would I be adding a lot of stores? I expect to grow. So that's the point. If I'm not adding a lot of stores, well, then I'm probably not going to grow as much, right? And if I'm shrinking my stores, I'm not even spending, then I might even be expecting to shrink. So this is just a very important ratio in a signaling effect of what management thinks about their kind of short-term growth prospects. Right? It doesn't always work out, but generally it's a good signal. So that's the other thing we'll look at, the ratio of Capex to depreciation when you go through this section. Now, we got $3.2 billion of free cash flow. We have $8.5 billion of CFI. So basically they added about $5 billion of non-operating cash flow. How'd they do that? Well, they got $3 billion from a non-operating gain. And they basically reduced $6.3 billion of non-operating assets. So between those two, that was almost $9.4 billion. They then put $4 billion into excess cash. As they increased their excess cash balance. So the net of that was about $5 billion. That was the increase in non-operating cash that led to the increase in the CFI from the free cash flow. Next, how do they distribute the $8.5 billion of CFI? This is the debt and the equity. Well, they gave $1.176 billion in interest payments. Okay, so that was an outflow. They had negative $20 billion of debt. Does that mean they paid off a bunch of debt? Or they issue a bunch of new debt? They issued a bunch of new debt. Now here's a question. Again, final exam type question. Did Starbucks need to borrow $20 billion worth of debt to fund their business? Was that mandatory debt to fund the operations? Did they need that debt? Yes or no? And there's actually an answer to this question. Yes or no, and why? Did Starbucks need to borrow $20 billion? Did the business need it? Yes.
Do you mean to sustain operations as they are, or like
Yeah.
to
To
fund?
sustain operations as they are. We're looking historically. To sustain those operations historically, did they need to borrow $20 billion worth of debt? Yes or no?
But I don't have a reason for that. So.
We need a yes or a no. Yes.
No, because they increased their Capex that's on that year.
Potentially, but there's something more important. What does $3.2 billion of free cash flow tell you? How do you generate $3 billion worth of free cash flow? What does that mean? It means you got more cash coming in than going out on operations, right? You got $3 billion left after reinvestment. Well, if I have $3 billion left after reinvestment, do I need to borrow more money to go buy more stuff? No, I do not. So that $3.2 billion of positive free cash flow tells you they didn't need to borrow the $20 billion worth of debt. So let's just hold this question for a second. Why might they borrow $20 billion worth of debt? Let's keep going. They spent $9 billion, 8997.6 on dividends, and they repurchased $21.5 billion worth of common stock. Now, how do you buy back $21 billion worth of common stock when you only have $8.5 billion worth of CFI? Matter of fact, if you pay out $9 billion worth of dividends and you have $8 billion of CFI, how do you pay out $21 billion to the shareholders by buying back a bunch of stock? That's the debt. They borrowed a bunch of debt to basically give the money to the shareholders. Does everybody see that? Now, don't get me wrong, a lot of companies did that. We were in an era of all-time low interest rates. And a lot of companies took advantage of that, borrowed a bunch of money and gave it to the shareholders. I'll borrow at 2% and give it to my shareholders, right? But as an investor looking at this, I like cash. I'm happy they gave me cash. But is this sustainable? No, it is not. They can't keep doing this. They can't keep giving me this much cash on a go-forward basis, because what you can give me sustainably is your free cash flow, right? And you're not making $20 billion worth of free cash flow. You're making $3 billion worth of free cash flow. So unless that changes dramatically, you can't keep paying it back at that rate. So yes, I'm happy that they bought back a lot of stock, but I'm not going to look at that as some long-term signal that suddenly the company's doing a lot better, because the only reason they're able to do that is because of the generosity of the banks, who, by the way, are going to want their money back at some point. Okay? So this is not a sustainable increase in shareholder return. Does everybody see how I'm making those conclusions? All right, that's a CFI analysis. Questions about CFI? Let's look at target. Over the 5 years, Target generated $18.9 billion worth of free cash flow. They did that by generating $31 billion worth of cash from the income statement, gross cash flow. They reinvested $11.8 billion into the balance sheet. That was an overall 38% reinvestment rate, which led to $19.3 billion of free cash flow before goodwill. They spent about $490 million on intangibles over the 5 years, almost all of it in 2018, to generate $18.9 billion worth of operating free cash flow. Over the 5 years, they had a Capex to depreciation ratio of 132%. In 2021 is 124%. They are probably growing moderately and continuing to open up stores. That's the expectation for probably 2022. They had $18.9 billion worth of free cash flow. They had $15.1 billion of CFI. They basically spent a little over approximately $4 billion in non-operating cash. Where did that $4 billion of non-operating cash go? They increased their excess cash by $4 billion. So they basically took $18.9 billion of free cash flow. They put $4 billion in the bank. They had $15.1 billion left to pay out. How did they distribute the $15.1 billion? They gave $2.7 billion in interest payments. They borrowed $2 billion worth of debt. Again, probably didn't need it. They paid out $6.7 billion worth of dividends. They bought back $9.2 billion worth of stock. That's almost $17 billion worth of payout on $15 billion worth of CFI. The debt's the difference. But unlike Starbucks, they got $15 billion of CFI and almost $19 billion worth of free cash flow. They can sustain the dividend. They can even sustain some of the stock buybacks without having to continue to borrow money. So I look at Target stock buyback differently than Starbucks stock buyback. Both of them gave me cash, but with Target, it could probably continue. With Starbucks, it continues at the behest of the banks. Questions? All right, in the interest of time, I'll just do one more quick one. Dollar General. What do we know about Dollar General? Over 5 years, their free cash flow is negative. It's $1.7 billion negative. So again, in this statement, how'd they fund the business is part of the way we're now going to be looking at Dollar General. Slightly different than Starbucks and Target. Okay? So negative free cash flow. Why do they have negative free cash flow of negative $1.7 billion? Well, because over 5 years, they had $12.9 billion of cash from the income statement, gross cash flow. They reinvested $14.6 billion in the balance sheet, almost all Capex. So their 113% 5-year reinvestment rate, they put in 13% more than they earned over 5 years. That's why they have negative free cash flow. All right, before goodwill of negative $1.7 billion and a trivial amount of goodwill, so basically with no acquisitions, basically $1.7 billion of free cash flow negative. Okay, so they're in heavy investment mode. Matter of fact, their Capex to depreciation ratio is averaged almost 600%, 566% over the 5 years. They've been in massive expansion mode. Even in 2021, they're spending 266% of Capex relative to depreciation. So they're not expecting to slow down their growth, right? So they're still expecting to expand and grow more than doubling the size of their depreciation. Now, how'd they fund the negative $1.7 billion of negative free cash flow to help fund that expansion? Well, they didn't really do a lot of non-operating. They basically ended up with $1.5 billion of negative CFI because they drew down about $88 million worth of cash and sold off $65 million worth of assets, right? So really, they still needed to fund the $1.5 billion. How did they do that? Well, they paid $476 million in interest. That's not going to fund them. They borrowed $11 billion, right? Now, they needed to borrow money, but $11 billion? Why'd they buy $11 billion? I don't think it all went to the stores. $1.6 billion in dividends and $7.8 billion in stock repurchase. How do you basically give the shareholders 7.8 and 1.6, which is $9.4 billion, when you have negative cash flow? They borrowed debt to not only give it to the investors, all the money they gave to the shareholders, they borrowed debt to also fund more store expansion. So they're basically making a big bet on their future, right? I'm not making a judgment right or wrong. I'm just telling you what the data is telling me. That's Dollar General. All right, we went through the ROIC tree analysis. We went through the CFI analysis. Questions about anything that you have to do. Your homework assignment is on Nokia. It's PDF. It's got both statements in it for 5 years. The fact that they're an international company should not scare you because these are percentages on the ROIC tree. And when you look at euros on the CFI, you'll notice I didn't even say dollars most of the time, just the numbers. Okay, same analysis regardless of whether it's a U.S. company or not. Remember, TAs, I have office hours next 2 days. Take advantage of that. If you're struggling with any of this, see everybody on Monday. Have a good weekend. Where's the sign-in sheet? Make sure you sign the sign-in sheet before you leave. Thank you very much. Again, have a good week.